When we make that risk very small, we are defining our risk. And we don't really spend a lot of time trying to manage that risk. As a matter of fact, we don't spend any time at all. That is our risk. And so that's what we're willing to lose when we put on that trade. So if we are capping that risk to that 10%, now, of course, this is the maximum size that we would ever make that risk. Let me just keep that in mind. Then we're always guaranteeing that our risk will never get too big. We'll never have a big drawdown. We'll never have a catastrophic loss. Of course, if you lose many, many times in a row, of course, that will add up. But what are the odds that you're going to lose before you actually have enough winners that are going to compensate for that and then bring you over the top? And that's what we're going to talk about, how you actually capture that profit. Now, there are a number of ways that you can do that. One is be directional and put on that fly. If you think that you have a good bead on direction, then you're going to do very well. And there's a lot of stuff that you have to take into consideration when you're in a premium collection trade. Probably the most important thing is that premium is decaying throughout the day. And unless you're inside the fly, you're not going to be able to take advantage of that premium decay unless you're maybe at the end of the day, right? But from the start of the day, that premium curve is not limited to the boundaries of that butterfly. As a matter of fact, it spreads way, way, way out. Just think about this. When you first enter the trade, you're entering it way out of the money, maybe like this. So if it starts moving towards your trade, you're immediately in profit. The cool part is that because you've taken such a little risk, it doesn't have to move very far before you're receiving substantial profit relative to what you think you would normally get. You wouldn't have to move too far before you're at 50, 100, or 150% return. Now, wouldn't you like to make 100, 150% return? Of course you would. And it turns out that the vast majority of our trades return somewhere between 50 and 250%, which is just outside of the profit tent of that fly. And so that represents a good portion of our trades, and those trades tend to totally offset our losses. Okay, so now that those offset our losses, what is left are those trades that get very close to or inside of the profit tent that make way more than 200 or 250%. They can make 300, 400, 500, or even 1,000% return. You get those, and now you start really multiplying your returns. The key is how you actually hang on to that profit. Price could be moving all over the place. You need to have a very specific framework that is taking into account the premium decay, the time of day, your position relative to the strategy, all of that. And then you need to practice a process that would guarantee some level of consistency in order to take those profits. All right, that's like big picture and how we do all of this.